Welcome to today's market report.
Global equities edged up, and a key part of the Treasury yield curve inverted further on Friday, a sign the US economy will stall next year, and that investors hope will lead the Federal Reserve to back off its aggressive hiking of interest rates. Surprisingly strong retail sales data this week hammered home the idea that the Fed will tighten monetary policy further, even though soft consumer and producer price pressures suggested inflation has peaked and would allow for lower rates. Treasury yields rose for a second day following hawkish comments on Thursday by St. Louis Fed President Bullard, who said rates needed to rise to at least a range between 5% and 5.25% to be sufficiently restrictive to curb inflation. The remarks were a blow to investors who had wagered rates would peak at 5% or below. Futures now show the Fed funds rate at 5.05% by May, up from 3.83% now. Boston Fed President Collins added to the hardline stance, telling CNBC that with little evidence, price pressures are waning. Policymakers may need to deliver another 75 basis point rate hike to get inflation under control. Three top policymakers in Europe also said the European Central Bank must raise rates high enough to dampen growth as it too fights high inflation. The impact of rising rates was felt in housing, where US existing home sales tumbled for a record ninth straight month in October as the 30-year fixed mortgage rate hits a 20-year high. Inflows to global equity funds hit their highest level in 35 weeks in the week to Wednesday, according to a report from Bank of America. The GBP edged north of 118.80 amidst a risk-on impulse, while the euro-dollar fell to 103.25 and oil price tumbled.
This is today's market news. Thanks for listening. We'll see you next time.